we get asked the question all the time, how do these companies lose properties and then they're continuing to build? It's because typically they're using a CMBS or a non-recourse loan. So it's not affecting their company as a whole long term. There are some protections with the borrowers. So it's what's called a bad boy carve out. And it's essentially what it is. If they're being a bad boy, there could be held recourse. So this is something, Wes, we've experienced it when we cross paths before with a previous company. One of my examples would be wire fraud, like somebody that committed wire fraud or misrepresented an appraisal. I worked for a company that no longer is in business, obviously, but they hired people to fill apartments to make it look like they were occupied when they were doing the appraisal process. Now that's an extreme case, but that is an example of a bad boy carve out. Okay, so then now the loan could become recourse. So then they can go back on them because they didn't follow the loan doc requirements. So it's this bad boy behavior, which gives it the name bad boy carve out.
Do you know any bad boys who own student housing? Yeah, they're out there. And I've worked with some of them. And once you do work with them, you'll learn how to sniff them out and recognize their bullshit. Welcome to the podcast, everyone. Again, welcome to the Student Housing Insight Podcast, where we are putting you in touch with the people who bring student housing to life. I'm your host, Wesley Dees. So a little bit about me in case this is the first time you've heard me, or maybe you just don't know. I've been in the student housing industry for going on 25 years now. And in addition to running Student Housing Insight, I'm also a consultant in the space. My firm is Providential Student Housing. If you ever need assistance or anything related to student housing, please go look us up at providentialstudenthousing.com. So as you heard from that snippet, today's episode is all about when a property fails. Specifically, when it fails to pay its debt obligation and the lender takes it over. Yes, we are talking about the receivership and foreclosure process with student housing. You know what? But before we get into that, I want to tell you a little bit about our sponsor for today's episode, Vector Travel. Let's go to that clip. Do you have fully vacant units on your property that you have mothballed until next semester? If you do, I bet you've thought to yourself, we should list those on Airbnb for game day weekends or for parents visiting their kids. Maybe you're in a college town like Austin or Raleigh or Tallahassee, and your city has large festivals and not enough hotel rooms. You know you could lease those units on a nightly or a weekly basis. Providing short-term rentals on platforms like Airbnb can provide a great source of ancillary income, but it takes it takes a lot of organization. There's the additional setup of providing linens and coffee makers and all the little things that a short-term tenant will expect. Then there's the regulatory and tax issues that could require additional work. More importantly, there's the time and labor to market on all the multiple platforms, handle the reservations and cancellations, the cleaning, and then there's the bookkeeping. All of this turns into a big distraction from the main job at hand, which is operating and leasing your property. That's where Vector Travel comes in. These guys know the short-term rental industry and they know how to relieve all of those burdens from the property manager. And best of all, they've become experts in how to do that with student properties. They understand the complexity of mixing travelers with college students. They know it so well, they can quickly identify if a student property is not going to be a good fit for their program. So if you have vacant units, reach out to Vector Travel and have them do a free, no obligation assessment to determine if enrolling your vacant units in their program will be beneficial. Go to vectorstays.com/SHI. Fill out a quick form to receive more information. You will also get the first month's service fee waived by going to that specific landing page. Again, that's vectorstays.com/SHI. So let me set up today's episode a little bit. First of all, this isn't just any episode. This is a class. We're about to take you to school. And the subject matter, it's not something that is going to be covered in a camp class or an ARM class. For those that don't know, those are designations that, you should be getting. Personally, I prefer the ARM, the Accredited Residential Manager designation, versus the Certified Apartment Manager. Both of them are great, but just my 2 cents. That's what I would suggest to folks. But what we are going to cover in today's episode is probably the most important stuff you are ever going to learn about the business side of student housing. We're going to be talking about the lending world of student housing and what happens when a property can't pay its bills and ultimately can't pay its mortgage. For a site level manager, that can be scary and frustrating. And hey, it's likely not the site manager's fault, because hey, if it is a site manager's fault, that's real easy to fix. And a management company is probably going to do that before anything else. So the interview you're going to hear today is actually from a session from our memo web series that we did earlier in the year with Elan Asset Management. Elan is ran by 2 student housing veterans, April Priebe and Brittany Herringshaw. April and Brittany have really seen it all when it comes to failed student housing properties. They have been, I call them the reset crew. They've been that reset crew for so many properties that became the victims of overbuilt and depressed markets, bad underwriting, and just general bad boy owners who were doing things they should not have done. So yeah, we're going to get into that too. So if you're not in a place where you can lean into this and take notes, that's fine. Listen to it leisurely, but bookmark it so you can come back to it when you do need it. And if you know a colleague who is going through receivership or potentially a foreclosure, send them a link to this episode and share it with them. It will offer them a ray of sunshine, and I think will probably help them sleep a little better at night, because if you've never gone through this can be really scary. All right, let's get to the episode. You guys remember the Great Recession of 2008 to 2010? I know 2020 has been a horrible year, and you may have forgot the Great Recession after all the events of 2020. And some of you guys watching this were probably in high school when the Great Recession was happening. So listen to the old guy for a second, and let's talk about some of the things that happened, not necessarily during the Great Recession, but specifically after. During the Great Recession, student housing development just really kind of came to a crawl, but development of student housing came back quick, because what happened? A lot of students decided to stay longer because there weren't jobs. So therefore, there was a bigger need for housing. But anyway, it came back very quick, especially going into 2011. CMBS loans, which is a term, if you're not familiar with, we'll get into it shortly. But they gained a lot of momentum in this sector coming out of the Great Recession. The student housing industry came roaring back in 2012 through 2015. And over those 4 years, there was over $7.3 billion in just CMBS loans that were made during that time. So why is that important to the discussion we're having today? Because those loans have 10-year maturity dates, meaning in 10 years, the balance of the loan is 100% due in one balloon payment. So from 2022 to 2025, the properties that were financed during that time will have to either refinance or they'll be sold. At the time I got into consulting in 2018, at that point in time, the number of loans that had defaulted was right around 6%. Excuse me, I shouldn't say defaulted. They were defaulted, but it was 30 plus days of no payment made up about 6% of those CMBS loans. That has slowly been creeping up since 2018 and is now at 14%, just to give you some kind of idea of the numbers that we're talking about. So as we get closer and closer to that 7.3 billion maturing between 2022 and 2025, we're going to see the properties that are performing well be refinanced. The ones that are not performing as planned, they stand the chance of defaulting on their loans. As you can imagine, the pandemic has not helped things, especially in the tier 2, tier 3 markets. When a property defaults on its loan, it starts a chain of events to rectify that default with the owner and the lender to determine if the property needs to go into receivership, where the lender removes the owner from making day-to-day decisions and pauses the debt obligations. So what does that mean for the management company and specifically the site teams? What does that mean for the residents? Well, I've got the perfect guest here today to give us the insight on how all of that works. April Priebe and Brittany Herringshaw are the co-founders of Elan Asset Management. Before starting Elan, April and Brittany had a ton of experience with other management companies who specialized in managing student housing properties through the receivership process. April and Brittany, welcome to Memo.
Hi, guys.
So guys, we met officially a little over a year ago, but we quickly realized that we had been crossing each other's paths somewhat indirectly for years. There was a kinship that I immediately recognized because we've been servicing some of the same properties and clients throughout our careers. And that's something that happens in probably every industry. But in student housing, it can be very unique to say the least. Can you guys talk really quick on your background and what led you guys to starting Elan?
Yeah, so I'll go first. Age before beauty, Brittany. So I started in student housing back in 2005, 2006 as a CA, and kind of worked my way through. Worked for an owner-operator for a multitude of years. Got my brokerage license, got back into it through receivership. So the company that was taking over a property that, Wes, you are very familiar with, that company, they were taking over a default on the property and had reached out to me and said, hey, we knew you used to run these properties. What would you like? Would you like to come and work for receivership? At the time, I was back at a stay-at-home mom. I didn't really want to work yet. And they told me it's receivership, could be 6 months. So I hopped on board with them, worked for them for about 6 years. Brittany tagged along 2 years into it, and I'll let her talk about that. But that broadened our horizon into receivership and REO in regards to student housing. And we did a little bit of everything too, commercial loans, golf courses. But my focus was on student housing and multifamily. With my background, it's hard to find, at least then it's hard to find someone that understands that asset class and willing to learn the receivership and REO side. So I hopped into that. And Britt, go ahead. Or how I met you.
Yeah, I started at a mom and pop leasing agency, actually at the apartment complex that I was living in at the time, just filing some papers, and quickly worked my way up to being the person that had to show the apartments on Saturdays. So that's how I got my start in leasing. When I graduated from college, I was like, oh no, what do I do now? And so I applied for a leasing manager position with a company called Copper Beach, which was a Campus Crest property. And from there, that's where I started leasing for what would become like owner operator, big box people going forward. And I was working at the same property when April found me. She was looking to fill a leasing manager position at a property that had just gone into receivership. So after a couple of years, April and I moved on to another firm where we were with a private owner operator that had a fairly large portfolio nationwide. And then COVID hit. And that was where we decided that we needed to put our dreams into reality. And we'd always talked about creating our own company. And there was Elan Asset Management. It was born right at the end of 2020. And we've really enjoyed working with student housing. And that's kind of where we came from.
Yeah. And our primary focus is we were reaching out to clients when we were starting this, and we have built student housing divisions at previous companies. And so what we were approached by several clients was, hey, we want to start managing student housing assets because we know there's essentially a second recession coming. And we'll get into a little bit about CMBS and how that'll affect it. But we need to have a student housing division. We don't know what to do. Can you come in and consult with us and create a vertical build for our companies? So we're working with a couple different clients doing that. And we also help with due diligence and things, especially with people that are newer in the student housing space. We both enjoy an education component to that. So teaching others what we know how to do and how to build it best. especially with our diverse background and what we've done with receivership and REO. We've kind of seen it all and seen when there's trouble brewing and how to avoid those. So that's primarily our focus with the line. And we've been doing well. We're prepping, unfortunately, for many, I'm prepping for a busy season here coming up. So
yeah, and I'm glad you mentioned the training element to it, because you guys have been training special servicers for the lenders, for several years now on the complexity with student housing and why they can't just jump into it like it's a conventional multifamily or even a hotel and treat it like they treat those that are in receivership. So you've done a great job of explaining that to them over the years. We've had some mutual clients that we've kind of crossed paths with, as we mentioned earlier. And I could tell you that the folks that knew you guys and had been working with you guys understood student housing so much better than other clients, that were in the same situation, and they were trying to service those loans and were really, lost in the weeds. So I can't say enough about how well you guys are doing that. And a lot of that's transferring over to what we're talking about today and how you guys are presenting this, because we've got some slides and things that we'll be showing, but there's even a couple other documents that you and I have traded back and forth that we'll put below so that the folks can download that and go through that themselves during their own time to help educate themselves a little bit better. Because it's amazing to me, especially in student housing at the site level, how many people just have never dealt with this, have never educated themselves on it. And believe me, I wish you didn't have to deal with it, but we are certainly headed into a time where this is just going to be reality. It's been reality for a lot of markets, but I think it's definitely going to be the case. And it's really kind of, I hate to say, a natural part of an evolving industry like student housing has been, but it really is. So let's jump into it. I think a good place to start is laying some groundwork and just basic knowledge about the lending industry that surrounds purpose-built student housing. As we've discussed in prior conversations, property managers in student housing typically have very little knowledge of the lending world, and even regional managers and VPs I run into don't understand it very well. And let me just say this: if you are in an executive position at a student housing management company and your company is not offering some type of training to on-site staff as it relates to the lending industry, you are not serving those staff members well. You're not. They need to understand this. Without it, they will not be able to serve their property as well as their ownership group to the best of their ability. Okay, I'm off my soapbox, ladies. What are the most common loan types for student housing properties, and what are some advantages and disadvantages associated with them?
So I think, at first, just to kind of relate to everyone. So when you buy a house, what do? You go to a mortgage company or a lender, you apply for a loan. There may be a couple different types of loans. There's, rule development, FHA, standard conventional. So, it's very similar in the commercial world when you're applying for a mortgage on a property in a sense that there's different types that you can do. Obviously, there's going to be more types in a commercial loan because there's a lot more dollars involved. So the 6 most common types that we're going to talk about are bank loans, the standard conventional, you're going straight through a bank. The next one would be CMBS, which we're going to talk in more depth today. Fannie Mae, Freddie Mac, which are agency loans, life companies, and then HUD. So you probably have heard of those. Life companies are a little bit less frequent, and so we'll get into those a little bit. So with the regular standard bank loans, those are going to be LTV, loan to value ratio of 65%. You're going to have a term up to 30 years, amortization. Depending on the lender, they offer different types of terms, whether it's balloon payments, fixed rates, things like that. They're originated, though, by a bank. Okay, so it's secured by the collateral of the property. And on rare cases, the banks offer a signatory loan. Brittany, I'll let you go ahead and get into CMBS.
Yeah, so CMBS is a little bit of a passion of mine. I think Wes and I could talk about these for hours, but it's It's my personal favorite loan type because a lot of people like to consider Fannie and Freddie as one of their primary sources. For example, Fannie has a loan to value ratio of 75 to 80%, and they can go anywhere from 5 to 12 years as far as terms go. And then Freddie is about 80% as well. So when you're looking for a loan type, that's where CMBS comes into play, and that's where the loan to value ratio is approximately 75%. So CMBS stands for commercial mortgage-backed security, and this loan type is asset-based, so it's very specific to the property. And then after originations, and this is where it differs from a lot of the other types of loans, after origination, they're pooled together and sold to a secondary market. So that's where it's a really key, important part of CMBS, and we'll kind of go from there.
And by pooled together, is that pooled together with other properties and loans from a single investment group, or is it amongst investment groups and properties kind of all over the place?
Yeah, it's all sorts of property types. So it can be hotels, it can be multifamily, it can be commercial, it can be retail, all those kind of things. So they actually just pool a very large pact together, and they call them tranches.
And we'll get into that too in a little bit.
Gotcha. All right, so that's CMBS. Tell us a little bit about agency financing. I think everybody's familiar with the terms Fannie and Freddie, but maybe they need to understand a little bit better about what those two names even mean.
Yeah. So Fannie and Freddie are government-backed or agency loan types. They're government-sponsored. They have a little bit better terms, just like if you would go with an FHA loan on a mortgage. You're getting a little bit better interest rates. But there's specific requirements that you have to meet, obviously, for those. So the property has to be 80% leased or more to grad or undergrad students. It's, for example, for Fannie Mae. It is a 75 to 80% loan to value ratio, so you can borrow a lot more. And the terms are usually a little bit more favorable than a bank loan or a CMBS loan. So you can do a 30-year amortization, 30-year loan on it, principal and interest. So with Freddie, very similar. It has a lower loan to cost ratio compared to Fannie, so a little bit favorable in regards to that. They do have floating and fixed term rate options with 3, 5, 7, or 10-year. But again, government backed. There's credit scores that you have to meet. And we'll talk a little bit about the disadvantages to those. Life companies or life estates, they're going to be like the group of life insurance companies, things like that, like the teachers fund, retirement fund, that are using to buy equity into properties to get a return on their investment. You usually see this in apartment, industrial, retail, office properties. So you don't see it as often. And then HUD, I'm sure everybody knows HUD. So there's specific requirements for that. You don't really see that in student housing at all, pretty much. Of course, because students usually don't meet the HUD requirements, but it's there.
I saw, and I was a part of a couple of properties that were done through HUD financing post-recession. It was kind of an exchange where it was in specific areas where there needed to be. It was a lot like what opportunity zones have been turned into. HUD kind of had this overlay of, hey, if you build in this area, there had to be some. Like, for example, we couldn't do 4-bedroom, 4-bath without having one of the bathrooms. They would have to be accessible from the common area, because the thought was that this ever ended up, being rented to a family or something other than students, then, there had to be that ability to have a common area access bathroom, right? So those are out there for sure. I saw quite a bit of that just right after the recession ended. So yeah, anyway.
There's a lot of parameters on HUD. You're right.
Yeah. And so I guess if you're buying a student housing property, you usually don't go that route. But yeah, there's obviously opportunities when that may be the case. So just kind of going over some quick vocab before we get into the advantages and disadvantages, just because we didn't know what we were talking about either before we got into receivership scenario and talking about loans. So there's terms that are helpful to know and understand. So there's recourse and non-recourse loans. So a recourse loan is a type of debt in which a lender can hold the borrower personally responsible for paying the debt. Okay. And then non-recourse is when the person isn't held liable, the debt is beyond the pledged collateral of the loan. So obviously non-recourse is pretty beneficial to a borrower. If something goes sour, they're not on the hook for it. They take the property back. They're free and clear. So we get asked the question all the time, how do these companies lose properties and then they're continuing to build? It's because typically they're using a CMBS or a non-recourse loan. So it's not affecting their company as a whole long term. There are some protections with the borrowers. So it's what's called a bad boy carve out. Is essentially what it is. If they're being a bad boy, there could be held recourse. So this is something, Wes, we've experienced it when we cross paths before with a previous company. One of my examples would be wire fraud, like somebody that committed wire fraud or misrepresented an appraisal. I worked for a company that no longer is in business, obviously, but they hired people to fill apartments to make it look like they were occupied when they were doing the appraisal process. Now that's an extreme
Holy cow.
But that is an example of a bad boy carve out. Okay, so then now the loan could become recourse. So then they can go back on them because they didn't follow the loan doc requirements. So it's this bad boy behavior, which gives it the name bad boy carve outs. So we always thought that was really funny and interesting to hear that. But that's part of a non-recourse loan. So that's pretty much it. You don't get a get out of free jail card all the time. If you run a property incorrectly, to try to get away with things with CMBS loans anyways, or Fannie Mae and Freddie too, there are those bad boy carve outs. The DCSR, some people have heard of it before. Brittany and I, before we got into learning anything about financing, we didn't quite understand what that was, but it's a debt service coverage ratio. So this is the ratio of operating income to the available debt servicing of interest, principal, taxes, those type of things, and your payments. So it's the benchmark that they use to measure the asset's ability to get enough cash to come in to make sure you're paying the debt payments. So if we say something like you're below the DCR or above the DCR, that's what that means.
Gotcha. What do you typically see banks? What's that trigger point within the loans for the DCR?
1.25 is the lowest. And so it's going to depend on the asset, but that's the lowest that at least CMBS will go is 1.25. So
yeah, once you fall below that, they really start watching you.
Yeah. Cash traps, things like that. So yeah, some of the disadvantages. Obviously, Freddie and Fannie, very favorable. They're really competitive for their pricing. You can get an early rate lock. So, buying a house, 30 to 45 days, usually you can close. So the rate locks aren't as big of a deal. But when you're buying a commercial asset, it could take 60 to 180 days to buy a piece of property. And so an early rate lock is important. Some loans, you're not even able to get a rate lock until 30 days before closing, and you could be 6 months. So obviously mortgage rates could change quite a bit between that time. So that's an advantage with the agency-backed loans. You have up to an 80% loan to value ratio, and they're non-recourse. Freddie, pretty much the same thing, but there's partial term and full term interest that are also available. So if you want a smaller monthly payment, you can go that route for a little bit. You can get supplemental loans, again, non-recourse. A standard bank loan is more rigid to the down payment, your income verification, your credit scores have to be a little bit better. It's like going conventional on a mortgage. There is some sort of recourse usually for the borrower, shorter amortizations, fixed periods. It's just going to be a stricter type of loan. So if you can go that route, it's usually easier to go with a bank that you know about or companies will use over and over again, but they're harder to get, especially when you're getting into the space. And then going back to Freddie and Fannie, you have to get those loans. You have to be, reputable in the student housing space.
Established, yeah.
And they're very established.
Bank loans, a lot of times you'll see them finance troubled assets, where Fannie and Freddie are looking for a stable track record, a stable borrower, and a stable management company.
Gotcha.
And then with life company, those are really aggressive. They have to be really great assets, likely to do like cash out type of deals. And they really focus on high class assets. So something that's going to hold, they don't want to have big risk, especially when you're messing with teachers' retirement accounts. So
yeah, I was just going to say, I think most property managers that are in our audience today, if their property is financed through, a life co, they know it because the asset managers for those groups are, at least the ones that I've worked with, are very intentional of explaining, hey, this is exactly what, this business is going to support. Right. And yeah, it's life goes. So you're not going to screw around with something that's high risk. So those are typically some of the nicer properties within student housing for sure.
Yeah, definitely Class A, and they're much less likely to do like cash out options. So when they set a term, it's a long term hold.
Gotcha. All right. So disadvantages.
Yeah. So I'll run through Fannie and Freddie. Basically, the biggest thing with Fannie and Freddie, like I was saying before, is that they're really selective on the properties that they choose to finance. They're looking for stable properties. They're also looking for a borrower that has a good track record and a management company that's been successful. So now is not the time to bring in a manager that's managing their first property. So those are the biggest disadvantages with them. I think it's also important, and we kind of have a saying between April and I, that you don't mess with the government. So they're government-backed loans, so you want to be really careful because they do have high expectations and you're expected to meet those. And then as far as bank loans go, for the most part, you see properties financed through bank loans. It's very common. However, they have very rigid down payments. They will actually verify credit scores. When you're doing a signatory loan, which is where they put their signature on the line to guarantee it, they will all check personal credit. So a lot of times people like to be a little bit more removed, and that's where you want to go with another option. And then bank loans also have shorter amortization time periods.
Gotcha. So those advantages and disadvantages we talked about, kind of the four. I hate to say less common; those are all common, but CMBS is kind of the main thing we wanted to deep dive into today. Brittany, can you talk a little bit about the advantages and disadvantages with CMBS? Other than the non-recourse, I think we've already covered that. Absolutely.
Yeah, so that is obviously one of the biggest draws to it. But they also have attractive fixed rates. So that's a set time period and a set interest rate. The loan to value ratio can go up to 75%. So that's a wide range of loan sizes. There's less scrutiny for borrowers, so it's a little bit easier for someone that has a track record that's not so great to be financed. And the loans are also fully assumable, which means that they could sell them and somebody could take over the loan. So other important thing about CMBS is that it can also be combined with mezzanine debt. So that's where you bring on an additional layer of liens. I know that Wes has some good stories about mezzanine lending experience. But I want to run through some really quick disadvantages of CMBS, and that's that there's limited flexibility to deviate from the terms of the loan. So once that's set out at the beginning, those are very standard and they don't really flex. There's also difficulty in releasing the collateral. So it's hard to dispose of it because you have to go through so many specific processes. And then it can also be expensive to exit. So there are prepayment fees that are associated with that. And then one of the biggest things that you'll find from borrowers that they are disadvantaged to CMBS is that you are required to have reserves on hold. That means that you actually have to have additional funding held back for emergency situations. When things go wrong, they can actually pull that money. The lender can pull that money to pay those bills.
And then sometimes mezzanine financing isn't allowed, just depending on the loan requirements for that.
Gotcha. So we talked about all of those different loan types, and as I mentioned, a lot of times that covers 65, maybe up to 70%, 75% of the loan. And especially with new development, developers are looking to bridge a little bit more to try to get it up to 80%. And a lot of times they go into what's called mezzanine financing. Brittany, I wanted to ask you a little bit. You've got a great slide here I wanted to ask you about, because I think it really kind of lays out the capital and the rate of risk and everything here. So tell us a little bit about this slide.
Yeah, so the mezzanine loan, which we wanted to highlight specifically here because it's a portion of the capital stack, is fundamentally different from a mortgage loan because the collateral is the equity, not the real estate. So we've kind of been talking about how in typical CMBS, you're putting the property on the line as the collateral. But in this case, it's actually equity that's put on line for the collateral. So when a mezzanine loan defaults, the mezzanine lender can foreclose on the parent's equity interest in the project as opposed to the property itself. So the foreclosure would not cause any change at the real estate level. The title to the project stays in the same name as the same project owner and the company as it was before, and the mortgage and other real estate documents remain in place, so nothing is changed on the title. However, the impact at the equity level is profound because the purchaser of the equity interest at the mezzanine foreclosure sale, which oftentimes can be the mezzanine lender themselves, will purchase at that sale, they get the right to own and control the company that owns the project. So the next best thing to holding the title to the project itself is holding the mezzanine debt. So they are number 2 in line, and that gives them a lot of rights to the property in the event of a foreclosure sale.
Yeah, that's a lot of times you'll see an equity partner actually, in addition to having the equity piece in, they'll also give a mezzanine loan on it as well, and it really comes down to that. So they've really got kind of control there if something goes haywire. So yeah, good point. So let's talk about the loan origination process. Can you guys just give a Cliff Notes version of what that's like, so that the audience kind of understands, who the characters and the players are in that process? Because I think before we get into talking about receivership, it's important to know who those characters are.
Yeah. So we're going to talk about the small piece of the much larger piece, because we don't want to get too much in the weeds on this. So the loan origination process, just like you would get a house, you find a house you want to buy. You have a loan application and a business plan that you would submit based on the loan type that you're wanting to do. There's different qualifications for that, depending if they need a credit analysis, if they're looking at financials, obviously, if they need any types of bank statements, depending on the type of loan you're going for. And then there's a deal structure. So they're looking at the risk rating calculations and how to get the loan approval package together. Then they'll get the collateral information. So the appraisal, the property reports, environmental reports, things like that as part of the sale. And then from there, you go into the approval process. So if everything checks out, there's the legal documents that are drawn up, any notification of the sale to the responsible parties. And then you have the closing. So loan is funded, you're on the credit, there's a credit file on it. So that's very small Cliff Note version of the loan origination process. Now, there are key participants in this origination, especially when for this situation, we're going to talk about CMBS. That's what Brittany and I are the most familiar with. We are not financial people at all. It may seem like that from what we're talking about. We're just scratching the surface. So we have a good general understanding of this stuff. So the participants in this, you have the borrower. Okay, the borrower is the one that's borrowing the money to buy the property. That's usually an entity. It's not usually one person. If they have mezzanine funding and stuff like that, it's responsible parties that are borrowing money. Okay, again, this is one level. This is the first level of this whole, CMBS process. So that borrower becomes the debtor. Okay, they own the property. They have to repay payment. They're responsible for performance of the asset and the obligations of the loan. And then from there, there's a loan originator or the loan seller. This is the person that actually lends the money up front. And so these are the banks that you're considering, like KeyBank or Wells Fargo or PNC or something like that. What we would know as a bank, that's who they are. And they're the first security of the loan, the first lien holder on it. So Brittany talked about mezzanine being the second. They're the first lien holder, which is very important. They have like the ultimate say on the debt. And then from there, you have a master servicer, which is also known as a primary servicer, depending on how many layers of the loan there are. And the master servicer is the person that's appointed to kind of handle the loan. That could be the loan originator. It just depends on how the debt is transferred. So if you've ever got a mortgage on a house and you went through one lender and then all of a sudden you get a notification in the mail saying, hey, your mortgage was sold to this other company, that's essentially kind of what's going on. So it may be the loan originator, it may be the same as the master servicer. It just kind of depends on the levels of the loan. So the master servicer is, again, collecting all the day-to-day. They're going to want to see, the reports. They're as long as the loan is being paid off and there's no issues, you're dealing with the master servicer typically. So any type of financials that are required on a yearly or quarterly basis, projections, things like that. Now, a special servicer, they're actually appointed at the time the loan is created. Okay, the pool is created. They're part of CMBS. So that's the same time they know who the master servicer is, the special servicer is then assigned. You wouldn't deal with the master or the special servicer unless there's an issue with the loan itself. So they're responsible for servicing mortgage loans that are in default in the future. Okay, so the loan may never go into default, but they're assigned in case that does happen. And then they also have special approval responsibilities for the borrower when there's requests made. Okay, and then here's where it gets interesting. There is the B piece. So who's the special servicer's boss? Because there's all these layers. They're controlled by the B piece. And we'll get into that. So Britt, you can the package.
Yeah.
Package.
before you get into the BPs, I wanted to break down the packaging of the CMBS loans. So I think it's really important to understand the different levels, which could take hours to explain. I'm sure in finance classes, they spend weeks going over this kind of stuff. We wanted to put together a really simple image for you. And that's in regards to all of the loans that are packaged together. So you can see in the image here where they have a bunch of buyers that come in and they put these loans together into a pool of mortgages. And so you'll see when we're talking about the master servicer servicing this pool, that's what we're talking about, all of these loans that have put in together.
And these are not just, again, student housing, multifamily. These are a pool of loans that are put together to sell essentially as a package. Like, hey, this is a good investment package. So they're going to have a little bit of everything to mitigate risk. Office, retail, student housing, industrial, yada, yada, yada. So they put these together. And the buyers are essentially buying into these pool of loans.
Yeah, and I completely get that as a potential investor. I don't want everything in student housing because you may have something like COVID that comes across, and that's same thing with hotels. Something like COVID comes across, and you're glad you've got student housing who relatively to hotel investment has weathered this much better. So yeah, that's a great way of putting it.
Yeah, and then now, where does the B piece come in, and why is it called the B piece? So you'll see this little chart here, A, AAA, AA. So the financial institution that are offering these loans to the borrowers are going to initially fund the loans. So if you go to a Wells Fargo, they're upfronting the loan itself, but then they're packaging basically to get funded through these investors. Okay, because the money has to come from somewhere. So they package these loans. Then they pull the loans together and securitize them. So securitizing just means they're making them into bonds. And when they're bonds, they then have to be rated by agencies. So then they're rated, and then they're leveled in investment grade. So this is coming from the AA down to the unrated. So below investment grade is typically going to be the double B and then under. So you can kind of see like the first loss, the last loss, lowest risk. So the A piece has the lowest risk. They're going to be paid back first. And the B has the highest risk, but a higher yielding. So these ratings are based upon the pool's average of the loan to value ratio, the DCRs, how the loans are distributed, property types in the pools, properties' ages, lease expirations, where they're located, how big the loans are, all those different factors. And so then after they're rated, the bonds are then sold to large investors for prices corresponding to the class of the bonds. And so then once the bonds are sold, the money the lender initially loaned to the borrower is then replenished, less the amount designated for risk retention. And then if those strips are sold, unless those strips are sold to the B piece buyers. So down here is the B piece. So why would you want to be a B piece, Brittany? There's so much risk. Why would you want to be that B piece?
Yeah, so the B piece, you'll see it called the controlling class bondholder, the CCR for short. The CCR can remove the special servicer without cause. They essentially are the special servicer's boss. So they come in and they're able to dictate the modifications of the loans, the foreclosure or the sales of it. They can even accept a discounted payoff. And they can then release ultimately the borrower from the liability of the mortgage. So being the B piece has the highest risk, but it also has the most control.
Yeah. So they're the B boss. So if we're looking at the layers, the borrower is very small considered either the controlling class bondholder. And it's almost impossible. It's not public knowledge to find out who that B piece is. There's very often we work on deals and we never know who the B piece is in this.
Yeah.
And so it's kind of like the Charlie's Angels. Is Charlie on the other line? You don't know where he is or who he is, or he's just that voice.
All right. So that's some terrific base knowledge of the how all this comes to be, how all this happens, how these deals get done, how they get financed. So let's start talking about defaults a little bit. Let's pretend I'm a manager. Let's say my property's 7 or 8 years old. That means that 2 or 3 years ago, the property had permanent financing put in place because most construction loans are typically no more than 5 years because they're just They're really just created to get the property to a point it should be stabilized. And we'll talk about construction loans another day. So I'm 2 or 3 years into a new loan. Some things become unstable. I think probably the most common example in the student housing world is some kind of massive amount of new development comes in and disrupts things. Right? I'm sure most people here can raise their hand that that's happened to them at some point in time. All of a sudden in that situation, you've got rents that drop, or worse, you just can't. And this is supposed to be an example about me. We can't maintain the high occupancy that we're used to. Cash is typically tight when you get to August due to turn. And let's say my ownership group makes the decision they're not going to pay the mortgage that month. What should we expect will happen next?
So when we're talking about CMBS default, there are 3 main types of default. There's term, maturity, and technical default. So maturity default is just your loan's matured. You didn't refinance it in time. You didn't pay off the balance in time. So that balloon payment has ended. And so it's, what are you going to do? So that's, I wouldn't say the most common, but that's number 2. Then the term default occurs when the borrower just can't make their payments. They can't make their interest payments. They don't have enough funds to do that. And so that's going to be they defaulted on their mortgage. And typically that to go into special servicing, that takes about 60 days and defaults. And then there's a technical default. So that's going to be when they didn't meet the loan requirements. So it could be, they didn't keep their occupancy permit. The deferred maintenance is so high. They violated some other requirement on their loan docs. And so most commonly it's occupancy, pre-leasing, deferred maintenance, or some sort of code violations that they didn't meet. So, and then once you do default, you're current then delinquent. Once you're delinquent 30 days, then you get sent a pre-foreclosure notice from the master servicer. And then that's when it starts becoming transferred to the special servicer. And so the special servicer will either try to work it out and reconstruct some loan terms, or they don't, and then we'll get into that, or they can. There's some modification, they start working it out again, but then there's a chance that they could stay current or they could default again, and then it moves forward. And whether it goes into receivership right away or foreclosure really depends on the loan docs, the courts, and the special servicers and master servicers that's involved. So there's a lot of variables there, and actually how the process works. It's not 30 days and then this happens. It varies.
Gotcha. Now, are there any other type of defaults that you see in student housing? I think kind of the example I'm given on my test property or example property is probably the most common, as you mentioned. But anything else that is kind of outside of what you just outlined?
So deferred maintenance is really big, or occupancy pre-leasing. So understand that with CMBS, it's non-recourse. So it's collaterally backed by the property itself. And so like a business, you have to make sure that's continuing to run effectively. If your business isn't running effectively or adequately, the value drops. And so then your collateral then drops. So sometimes it can be triggered by if they've done an appraisal and the value all of a sudden drops significantly. And then there's a risk to the loan. It could be you didn't charge enough market rent. Obviously, we've had that happen quite often. And so, when you're foreclosing on a single family home, the person walks out and shuts the door. But when it's a business or commercially backed loan like this, the business is the collateral. So you can't just, a borrower can't just shut the doors and walk away. So that's when, a receiver may be put in place to prevent that from happening. So that's, for us anyways, that's the most common, is the default of the loan, or they did something to disrupt the value of the asset itself.
Gotcha. All right. So again, I'm that site manager, and the property wasn't able to make the payment in August. So we're now put on a watch list. Still not able to make September's payment because I'm still waiting on students to get financial aid distributions. All the things that come up. So we're at that 60-day plus at that point in time. It's determined that the loan is going to need more than just some type of simple modification, and the lender decides they need to step in and assign the property to receivership. Is it time for me to find a new job at that point?
No, no, not at all. Unless you're not doing a good job, but typically it's not the on-site staff. Very rarely does the staff know what's actually going on. I mean, there's some red flags, obviously, when they start telling you can't buy toilet paper, which yes, we've had happen. There's some things that you can look into, but if you're doing what you can do to keep the asset going, you're already really dedicated if you're getting to that point where it is going into a receivership or foreclosure situation. Now, with receivership, you're more likely to be kept in place just because of how a receiver is handled. You get a court appoints a receiver. And the best way, what we get asked all the time, what is a receiver? So a receiver is, again, appointed. It's a neutral party. The best way we use to describe it is it's the foster mom. So mom and dad are getting divorced, and a divorce doesn't happen overnight. So they're going through litigation and trying to figure out how the best is to split. And so there's a foster parent, which is the receiver, that's put in charge to protect and maintain the asset while it goes through litigation. So the borrower is no longer responsible for the day-to-day operation. They do not have control over it. So the receiver is acting on the owner's behalf. So at that point, title hasn't transferred. It is still owned by the borrower, but really who owns anything when you have debt on stuff? But it's still owned by the borrower. But they just don't have control over it. So the receiver is acting on the owner's behalf, just like a foster parent would act on the child's behalf. And so they're neutral. They don't technically work for the special servicer. They work for the courts. And so there is a conflict of interest sometimes when a management company is hired by a receiver. Usually we see a receiver management company combo. And so they have a good working relationship already. Receivers don't like to appoint management companies that they don't work with. Just because it takes a lot to get that rapport and to understand the basics of receivership. So you don't see it very often. But if it is going into receivership, there's a lot more protections for the staff that's on site and a lot more room for growth. And that's how Brittany and I started in all of this, is we were working in receivership. So no, it's not time to find a new job. It's just put your foot forward and show what you know, and make sure that you listen to a receiver or the management company so that you know that you're acting in the court's best interest. So there is a legality aspect to it, but it's nothing to be scared about. I think the important part is to if it ever happens to you, to understand the processes of it. Read what a receivership is if you ever get put in that situation, because it can be very scary, but it is not a foreclosure, not at that point anyways. So it's not like you're going to be locked out and not have a job to come to the next day. So
I think it's important to know, too, that as the receiver comes in, they typically do terminate the management company, but we're talking about keeping your job as in you would then be absorbed into the new management company. So you go through the standard interview process and be hired on by the new management company. They typically like to keep the staff on site.
So I may end up becoming employed by a new management company, but if I'm operating the property well, the new management company will likely keep me on. So for anybody out there that's currently facing this situation, maybe the receiver hasn't been assigned yet, but you know it's going that way. This is the time, as long as you feel confident you're doing a great job, and that this is something that, and in most situations, I mean, ladies, correct me if you think I'm wrong on this, most situations where the bank decides that they can't get into that a modification is not going to be able to work out, or some type of extension isn't going to fix the issue, they know that it's typically not the on-site staff that causes this issue. It's more of a market issue. Is that what you guys typically see?
Yeah, when it comes to the three types of defaults, the first one and the second one, the two most common ones, are solely dependent upon the borrower. The on-site staff has very little to do with whether they can pay their mortgage on a monthly basis. They're not the ones that are working directly with the lender. It's the third one, which is the technical default, where property managers can make a very big change. And that's the occupancy, that's the upkeep, that's the marketing. That's where you can come in and make a really big difference to help avoid a technical default, and then ultimately keeping your job if the property does go through.
And I think, and Brittany can agree with me on this, when we've taken over properties in transition, we always like to keep the on-site staff there. We like to give them a chance, at least 30 days. There are some receivers that are not like that kind of go in guns a-blazing, but that's not the best course of action. And I think that's why our clients like working with us, because we're not that way. But, put your best foot forward. And I think what's important is to be open to change and to be open to suggestion and what the legalities are of it. When you have a receiver coming in, they know a little bit more about the legalities and the law than you think you may know. So unless you heard it coming from an attorney's mouth, I wouldn't necessarily say that you know everything. I think usually when we have a hard time, it's when we're coming into staff and the staff knows more than we do. So be open to learning. Doesn't mean everybody's always right, but that's a training component. So be willing to learn about, the changes that take place, and understand that when it is in receivership and REO, it's not the same as it would be as if it was owner operator. There are some finesses that you have to kind of work with. So
let's play that out a little bit. Again, so I'm the property manager. I've been able to stay on through this transition, right? But my property still has low occupancy, and we may need a little bit of money for new amenities in order to compete. Heck, I may also need to start talking about renovating kitchens. How can I get the lender to understand that, or I say lender, the receiver, and is that something that's on the receiver's radar when they come in to take a property over?
So when we're talking about any type of capital improvement, so the receiver's job is to protect and maintain the asset. It's not to add value. Now, increasing value and adding value are two different things. So you can increase value by what? Increasing occupancy, increasing the price of an amenity or the price of an apartment by updating kitchens. So you kind of have to be a little bit careful. But if you explain what could be used, don't understand that we may not be able to do everything, because there are restrictions, court-ordered restrictions that you have to abide by, and that all parties, anytime you do a lot of capital improvements, if they're not life and safety, they have to be approved by all parties. So can you add a clubhouse? Sure. I've been part of a receivership where we built a $300,000 clubhouse in receivership, which is unlikely at times, but to improve the condition in the apartments, to increase security, to update lighting, to, fix deferred maintenance. It's how you kind of word it. It's like when you're putting in an insurance claim, it's how you word things and how you approach it. So as long as you're open in sharing that kind of information, what the goals of the property are, and you have a good relationship with either the receiver or the management company working with the receiver, then you can kind of get those goals. So for Brittany and I, receivership is like the golden ticket. It's one of the best things that can happen for a distressed asset. You can see things and do things that you weren't able to do when the property didn't have enough funds to get things done and taken care of. And so if you've ever worked at a distressed asset and you're like, I'd like to replace the front doors because they're not latching, but we don't have the money to do it, which is very common. That's some stuff that they like, at least it shuts, you're fine, but they're not shutting, or the key fob system isn't working accurately. Those are things that you can immediately make a change with. It may take some time, just depending on the special servicer and the funding that's required for it. And by time, we're talking a couple months, if not. Usually, though, for us, if it's life and safety, it's within a week, if not faster than that. So, yeah, there's a lot of things you can do in receivership. You're not going to be going and building new buildings, obviously. But in student housing, that's why we also like working in receivership, because turn is every year. So you have that ability to make a bigger change faster than if it was in a different type of asset class.
Yeah.
And a good property manager is aware of all of those things, and receivers love ideas and they love feedback. So being aware of them and being able to share those if and when this process begins for you is very important.
That's such of a key point. I mean, I've been involved in a couple of situations where, it probably should be in receivership, but the owner has kind of taken that last stab at and basically saying to the lender, hey, we're going to change the management company. We feel like our problem is the management company. It's really not. In some situations, it may have been, but in most cases, it's not really the management company. And so they make this change, and it's kind of a last ditch effort to make sure that in a story to give to the lender in a lot of ways. And so I've been in that situation where I've been I've been a part of a company taking over someone in their last ditch effort. And if there's any business development guys and gals that are listening to this right now, you hate you can recognize it a mile away. and I get you really want to take that stuff on and try to turn it around and have this great story for your management company as well. But I think sometimes the better thing to do is to just explain to that owner that, they're in a situation where maybe you're going to be able to help, but likely these are outside forces that are causing this. And a simple change in the management company is probably not going to work. But to get back to your point, it is really something that it's not necessarily a golden ticket. But when I've been able to come into those situations as a last ditch effort, and those managers who've been able to say, almost like in list form, hey, I need A, B, C, D, and E just to, get this property to a point where I feel good about going to the housing fair and asking people to sign a lease for next year. Those are the managers that are going to be staying around and are going to be helping turn that property around when it does go into receivership. So yeah, for those folks that are out there watching this and you haven't experienced that, but you're afraid that you may, or you want to make sure that you're prepared, when you do face that, that's the key thing is knowing that property and what is going to be able to have the confidence of your residents and your prospects. So
if I can add to that, Wes, I think it's important to do the things that you can control. It doesn't cost a lot of money to do the cleaning. It doesn't cost a lot of money to go around and pick up trash. You may not be able to replace a roof, but can your maintenance guys go out there on a weekend or something and touch up some paint on doors and things like that? So the things that you can control that are within your powers are the type of things that show not only owners and lenders your value, but it also is maybe potentially the golden ticket to keeping your job in the event that this happens.
And to go off what Brittany said, I think it's important to understand if your property is distressed or you feel like there's some red flags going up, like, hey, something's not right, don't give up. If you're at that property and you care, continue to show that you care, because there's a lot of things going behind the scenes that you don't necessarily know. I can't tell you how many properties, because we like to think we look young, that Brittany and I have gone physically to in shops before we take over in receivership, and we scope out the staff, and they do it. And, there's a lot of young asset managers now that could pass for college kids easily. And so they're doing the same thing. They're going and shopping and scoping, and you would never know. And so, there's times we've walked right in and we've got pointed at, I know who they are, and oh shoot, did I say the wrong thing? So keep that in mind. Like, just keep showing and keep putting forth an effort, because it's only going to make you look better as a manager. And I know it's super frustrating, and Brittany and I have both been there. I mean, we talk about the companies we worked for in 2012. Out of the top 20, 10 of those student housing companies are no longer in business. So it does happen. It's unfortunately it's frequent, and it's just kind of growth in the industry. Mistakes are made and things like that, but show as an on-site staff, you're very valuable. And as long as you kind of put your effort in, there's nothing you need to worry about.
Well, ladies, thanks so much for your time today and explaining all of this. I know our audience is certainly better for it. If we've got someone in our audience who may have more questions, or maybe they've got an owner that they want to refer to you, how is the best way for them to get in touch with you?
So, and Wes, if you wanted to pop up, we have a slide that has our email and phone number on it. You can also scope out alignam.com, and Brittany and I's contact information is right on there. Also, you can shoot us a message. So we love to network. We love to talk to people and tell them what we know. That's kind of the educators in us. So yeah, we're happy to chat with whomever. So.
Call, text, send a carrier pigeon, find us on LinkedIn. We're happy to chat with you.
Well, and you guys are both located in the Midwest, so Central Time Zone is applied, and which is kind of easy for everybody on both coasts. So love what you guys are doing. Thanks for spending the time with us, and we'll talk to you soon.
Thanks, Wes.